Hi everybody, Thatcher came in from Taste Media Group coming to you on LinkedIn Live this afternoon. We're going to switch it up a little bit and bring on two people for this interview. Our first participant is Amanda McMillan of Chicago Home Partner, an affiliate of At Properties, and also Scott Martin, the CIO at Kingsview Partners. Scott and Amanda, thanks a lot for joining us this afternoon.
How you doing?
Thanks so much for having us.
All right, so we have two people on at one time here. This is a first. We're making some history here. But our main objective today is really to talk about a particular topic. So today we want to talk about consumer confidence. And Amanda, I'm going to start with you. If you could start at almost the micro level of real estate, the logistics of people coming in and viewing homes as things have changed even since it's 2 weeks since we last talked. And also the macro, just what you're seeing in the overall market for real estate as well.
Absolutely. And I mean, I think you hit on the two nails on the head appropriately. We're looking at this from two different perspectives when we do talk about things like consumer confidence. First of all, the logistics, the day-to-day of what we're doing. We've essentially taken our position, our field, and we've made it about 90% virtual. So that was a major shift. It happened over about a 72-hour period of time, although we're spending every waking hour trying to perfect that as much as possible. That being said, it does still leave 10% to be face-to-face, which we know that in an environment like that, like what we're in right now, that does have risks. In terms of the consumer's confidence with that, I think we're seeing a very widespread objective to it. We've got some consumers that feel very, very confident in it. We have some consumers that don't. Obviously, our protocol has been heightened. So if we're going to meet face to face for something or go into somebody's property, we are doing everything we possibly can do prior to that happening to make sure that it is an event that does have to happen. So the times that we're doing it are if we are doing a showing to get to a point in which we do want to walk through, we've usually done several levels of virtual showings prior to that. We do have certain clients that are buying completely virtual now, but I would say a vast majority do want to at least walk through the property once. So we have some consumers that don't have the ability, the luxury to wait. They are doing it now under a lot of protocol. And then we've got others that say, hey, I don't have a pressing timeline. I don't have an absolute need right now. I'm putting it on the back shelf from that perspective. So to me, it feels a little bit bipolar in terms of the reaction that we're getting from consumers on that front. But I think they are finding confidence in the fact that there is so much protocol in place and that we do have a lot of things that we're making sure that we're doing it as safe as possible. Now, change the game, look over at the other side of the equation, what's happening in our markets and confidence in that. That is, I mean, once again, I'd probably agree that it's a little split. We're a few more weeks into this, so now we're not just relying on historical events. I mean, leading up to this, everything we were talking about is what happened at this time and how did the country react and how did the mindset react and how did we come out of it? Now we're getting more and more data that's supporting a lot of what we're thinking. So absolutely, we still see it from an economic level. We've got a lot of alarmists out there within the field of real estate. But I do feel, like I said a couple of weeks ago, we are getting data that is supporting the fact that real estate, where the level of business happening is definitely dropping off. The prices aren't, the market's not necessarily changing. And in fact, certain markets are actually are speeding up in certain ways. So we're seeing a very, very big division in our markets. I would say under a certain price point, probably under $500,000-$600,000, that market is being very, very sought after. I've been in a more than one multiple bid in the last few days. So that market is still churning and moving with not a lot of options for consumers, but still consumers that need to be doing things. I would say our upper brackets where people have a little bit more hesitancy right now, that's where we're seeing the people that are not certain where their economic wealth is right now because of what's happening in the bigger markets, the portfolio products, those types of things. That's where we're seeing a little bit more hesitancy.
That's great information, Amanda. And just from what you've been seeing since the last time we talked 2 weeks ago, has the web traffic indicated anything that you're seeing in particular, just in terms of people doing searches for homes? Has that data come to the surface yet?
Absolutely. So that's one of the things that we're looking at. I mean, we look at what we're studying in terms of the real-time stuff is first and foremost, we're studying year over year. So how many homes were coming on the market a year ago versus now, how many homes were going under contract a year ago versus now, as well as for the closed data, that gives us our most price sensitive data. We don't have that yet. We're not far enough into that. So for that, what we're looking is we're comparing week to week over the last 2 months. So all of our data is showing us that the number of transactions are slowing down. That's not a surprise or a shock or a scary thing to anybody. The number of transactions are absolutely getting quieter, not silent, but quieter. And our prices seem to be holding their own from that perspective.
That's great to hear, just that those prices are holding for the market in general. And switching over to Scott Martin, more on the market side of things, Scott. From what I've been seeing, it looks like cruise lines, airlines, anything that involves actually people transporting themselves doesn't seem to have that much confidence, but we have seen certain boosts in the restaurant space. It's very interesting to see where consumers are drawing that line in terms of what they're comfortable with, moving forward here, and also how the market's reacting. So what are you seeing on your end?
Yeah, sure. I mean, some restaurants are doing better than others, Thatcher, because of their maybe set up for pickup on curbside, and certainly online and mobile ordering is definitely huge now. So companies and restaurants that can handle that flow are certainly doing okay as far as stocks. But like you said, hospitality-wise, hotels are another one that are not doing so great. Even some of the ride shares stocks are not doing so great. One thing that Amanda said that I really like, though, is with anything in investments, I mean, we manage money for folks. We help with retirement planning, investment planning, income planning, things like that as a fiduciary investment advisor here in Chicago. And it's all about price. It really is. I mean, things lock up, markets get crazy, they get emotional, but there is an importance to having a market, whatever it is, to whether a liquid market where you can buy and sell is still to this day one of the most important things that I feel we can have available to us. And certainly we may not like the prices. As Amanda said, different levels of pricing are seeing different impacts when it comes to COVID-19 and when it comes to the economic slowdown. But the reality is things are holding their own in certain areas and other things maybe still locked up. And we're seeing that too, Thatcher, in some of the areas that you mentioned of the U.S. economy, where some prices for restaurant stocks, some prices for hospitality stocks, still in our opinion, may not be to fair value because of the stresses they've had with the ongoing economic impact. So for me, as an investor, as a money manager, as consumer confidence, which has just taken a record dive over the last couple months, as we can imagine, as everybody's staying inside and is worried about the future. As consumer confidence, though, does bottom out, as the economic data does bottom out, as the government, as the Small Business Administration, as banks come to the rescue to some degree, the best they can for the economy and certainly for the small business owner and the U.S. consumer, as those things start to come through the pipe, I believe that will help support consumer confidence here. And as a result, continue to help maybe support some of the real estate activity that Amanda's talking about, and then ultimately support stock prices. I don't believe that we've seen the end of the volatile stock market, the end of the volatile interest rate market, but the confidence is getting to a point where it gets overwashed, it gets washed out. The market does tend to preempt, and I think of the market as in stocks and bonds, tend to preempt some of the worst days that end up coming to realization, because that's just what the stock market does. It's a forward-looking indicator. So there are things that are going to happen in the future that might be really scary, whether it's developing on the coronavirus side, whether it's developing on the economic side, and you may see less of an impact even to the real estate markets, but certainly to the stock and bond markets, because the market has already discounted those things. So as an investor, just keep those things in mind on how those cycles work, how confidence work, as it relates to how stock prices and bond prices behave.
And I think that's so key, Scott. As much as the government regulations will come back online here, movement is allowed within cities, it just is going to come down to how confident is the American citizen / consumer to just leave their house and hopefully spend money within the economy to get things moving again, which is the main question here in this moment. Amanda, if I can throw one last question over to you. Are there any indexes in particular that you're following in terms of consumer sentiment, or how do you kind of follow that outside of your direct real estate data?
Well, that's a good question. I mean, I think a lot of it I'm tapping into, as I've said before, I follow a lot of economists that are paid and way smarter than I am to essentially just study the data all day long. So I rely on their sources to become my sources from that perspective. But I would say a lot of what we're doing is just tapping into the experiences, the expertise, the historical trending, and then the data that we're able to really look at time and time again. I mean, the one thing that I don't know if I quite came back around on your last question was just with regards to the online traffic. That's one thing that we're watching right now. I know I said it last time I was here, is right now we have a very, very captive audience, and homes have never been as important to people as they are right now. So we're actually watching the growth of the online traffic. And pretty much, as I tell everybody, anything that has an online presence has a behind the scenes that we can be tracking and charting and watching. So we're watching that growth exponentially, so that where our foot traffic through homes has obviously gone down, the number of homes on the market has gone down, we are seeing that the attention has not gone down by any means if we start valuing it from a different sector.
And Scott, when you see the government making broad programs across the board, whether it's the stimulus, whether it's a production or infrastructure type bill, or even what was been floated lately is in terms of being able to bring American factories back to the states and stateside, do these announcements help create heightened consumer confidence, or can they kind of be false starts if the programs don't happen automatically?
They tend to be Band-Aids, Thatcher, because ultimately money flows where it's going to best be treated. Business flows to where it can operate the best. And while those programs do, I believe, help encourage some business development, the reality is, I think to your initiation there, how long lasting are they? What do those programs look like in a year? What does the economy look like in a year? Does it really help generate that resurgence that everybody's looking for? What I do think it does do, though, is it does give some business owners, it does give some consumers, again, back to that word, the confidence to know that some sort of backstop is in place. But ultimately, the funny part is, while a couple $1 trillion of stimulus, which these days is kind of not much, frankly, because we've got about a $20 trillion economy, and we've had a few of these programs now floated out there in DC. A couple, $1 trillion here tend to more have a short-term effect than they do a long-term effect, because the market was expecting these. And so really what you have to do is you have to go back to the reality of bringing all this factory production stateside, whether it's industrial related, whether it's pharmaceutical related, is stuff that's going to take, really frankly, years to restructure. And so companies that are all excited and hopeful about these things that they're going to change in their pipelines and their supply chains aren't really that geared up to do that, say, by June or by December of 2020. And so that's one thing we have to keep in mind as investors as well. You want to shut off parts of the world and say, that's fine, we won't buy anything related to China anymore, or we won't buy anything maybe that sells products in India because we don't want that exposure overseas. Well, the reality is those are major economies getting almost as big as the United States. I mean, not quite. U.S. is still the largest economy in the world, but those two areas I mentioned are catching up. And they're big components to what companies both in the U.S. and internationally are doing with their plans in the future. So when it is nice to have the government here and present, because they kind of missed the boat a little bit in 2008 when we had some of the real estate crises and the housing market bust. It's nice to have them available and aware of the problem, and certainly understanding the depth of the problem. It ultimately is going to come back to those businesses, the consumers, to really keep this thing going versus what the government's going to do overall.
That's great insight on consumer confidence from both Amanda McMillan of Chicago Home Partner and Scott Martin, the CIO at Kingsview Partners. Consumer confidence, everybody, that is going to be the key component moving forward. Thanks, Amanda. Thanks, Scott, for your time, and thanks, everybody, for watching.